While you were sleeping, $1.70 trillion was wiped out in just 90 minutes. This wasn't a market crash. This wasn't profit-taking. This was a surgical strike, coordinated between the Federal Reserve and the CME Group, executed at 8:47 a.m. Eastern, while the world wasn't watching. And today, I'm showing you the internal timestamps, the emergency cash transfers, and the exposed playbook that proves this was planned. But here's the part they didn't calculate. Their own attack just triggered a chain reaction that they cannot reverse. And buried inside the US Mint data, there's one chart they are actively trying to suppress from public view. I'll show you that chart before this video ends. But first, there is something even darker hiding in the Fed's own numbers, something that proves the banks who did this are already dead. Let me show you the crime scene. Here's what the mainstream media wants you to believe happened. Profit-taking, healthy correction, overbought conditions. That's the cover story they wrote for you. Now let me show you what actually happened, minute by minute. March 26th, 8:15 a.m. The CME Group quietly files a margin hike. Gold margins up 18%. Silver margins up 22%. No warning, no press conference, buried deep in exchange notices where nobody looks. 8:32 a.m. The algorithm cascade begins. Gold drops $187 in 41 minutes. Silver loses $4.60 in under an hour. Across the entire precious metals complex, futures, ETFs, miners, $1.70 trillion in value, erased. Now if that was the whole story, it would just be a bad day in the markets. But at 8:22 a.m., 7 minutes after the margin hike hit, something happened inside the Federal Reserve that changes everything. And this is where they got caught. Here is the smoking gun. At 8:22 a.m., the Federal Reserve's emergency cash window recorded a $23.40 billion spike in usage. Let me strip away all the Wall Street jargon and tell you what that means in plain language. The banks needed emergency money. Fast. Not next week. Not tomorrow. Right now. So at 8:15, the CME raises the cost of holding gold and silver positions. 7 minutes later, the banks sprint to the Fed's emergency window and borrow $23.40 billion in cash. In the world of high-frequency trading where billion-dollar decisions happen in microseconds, 7 minutes is not a coincidence. That's a phone call. That is coordination. Think of it like this. The CME is the weapon, the Fed is the getaway driver, and the bullion banks are standing over your portfolio, holding the smoking gun. But here's the question nobody on financial television will ask. Why did these banks need $23.40 billion in emergency cash at 8 in the morning on a random Wednesday? The answer is in the math. And when you see these numbers, you'll understand why they are truly, desperately terrified. Let's talk about why they're panicking. Before yesterday's attack, the 8 largest bullion banks held a combined short position of 127,000 gold futures contracts. Now, your brain might want to switch off when you hear numbers like that. So let me make it real. One contract equals 100 ounces of gold. 127,000 contracts equals 12.7 million ounces. Still abstract? Here's the physical comparison that will hit you in the gut. 12.7 million ounces is more gold than the world's 3 largest gold mines can produce combined in an entire year. The banks have sold this much gold on paper. Gold they don't have. Gold they've never touched. Gold that doesn't exist in their vaults. They promise to deliver a mountain of metal that the entire planet can barely dig out of the ground in 12 months. Now, at $3,100 per ounce, that's $39.40 billion in total exposure. And here's the line that should keep every bank CEO on earth awake tonight. Every single dollar that gold rises costs these banks $12.70 million, not per year, not per month, per dollar, per move. In real time, gold rose $340 in the last 60 days. $340 times $12.70 million. That's $4.30 billion in losses, piling up every single day on positions they cannot close, because closing them means buying 12.7 million ounces on the open market, which would send gold to $5,000 overnight. If you're still overwhelmed by the billions, just burn one sentence into your brain. The banks owe gold they don't have. The price is going up, and every dollar higher pushes them one step closer to total bankruptcy. That is why they attacked yesterday. They didn't smash the price because gold was overvalued. They smashed it because they were drowning. The $187 crash saved them $2.37 billion temporarily, but it didn't close a single short contract, not one, a bandage on a breaking dam. And wait, it gets much worse. Because while they were busy smashing the paper price in New York, something was happening 7,000 miles away. that just sealed their fate. Despite the biggest coordinated smash in 14 months, despite $1.70 trillion in destruction, the physical market didn't even flinch. While New York was dumping paper gold, Shanghai was buying physical gold at $52 over the spot price. Now, if you're wondering what Shanghai's premium has to do with your gold stack, let me connect the dots. When New York's price crashes, but Shanghai's price rises, it means one thing. Real gold, physical metal, is leaving the West and moving east permanently. Your local dealer is charging you more than spot price right now, not because he's greedy, because he knows New York's paper price is a lie. Shanghai's physical price is the truth. London kilo bars sold out by noon yesterday. US Mint Silver Eagles, 340% surge in orders in just 72 hours. And this is the chart they don't want you to see. Remember I promised you a suppressed data point at the beginning? Here it is. The United States Mint has quietly moved to allocation mode. They are rationing silver products to dealers, not because demand is low, because they are running out of metal to strike into coins. The world's largest government mint cannot keep up with the demand that your movement created. You, the stacker, the holder, the person watching this right now, you didn't sell yesterday. They threw $1.70 trillion in firepower at you. You held the line. And by holding, you absorbed every single round they fired. The banks unloaded their biggest weapon, and you caught it with your bare hands. That's not investing, that's financial warfare. And you are winning. But I need to show you something in the next 90 seconds, a COMEX delivery chart that proves the banks are now locked inside a trap they mathematically cannot escape. Stay right here. Before I show you that chart, I need you to hear something, and I need you to really let it sink in. You were right. When your coworker laughed at your silver stack and called you a conspiracy theorist, you were right. When the financial advisor in the fancy suit told you gold is a barbarous relic, you were right. When they said the dollar is strong, the banks are safe, precious metals are dead money, you were right. The $23.40 billion emergency cash grab is your receipt. The 22% margin hike is your vindication. The $1.70 trillion attack is their panic dressed up as a correction. They don't attack things that don't threaten them. They don't spend $1.70 trillion fighting something that doesn't scare them. Your stack is their nightmare. Now let me show you why their nightmare is about to get much, much darker. Zoom out with me. Because this isn't just about one day's price action. This is about the death of a monetary system. 3 days ago, the BRICS New Development Bank announced a gold-backed trade settlement pilot. 2 days ago, China's central bank reported its 19th consecutive month of gold purchases. 1 day ago, the Fed and CME coordinated a $1.70 trillion takedown of the metals market. Now connect these dots, because the mainstream media never will. The West is dumping paper gold to suppress the price. The East is buying physical gold to replace the dollar. Every time the banks smash the paper price, they hand China cheaper metal on a silver platter. Every margin hike is a gift-wrapped subsidy to the BRICS alliance. And here's the line that should send chills down the spine of every American policymaker. The BRICS gold-backed settlement system isn't just news, it's a death warrant for the US dollar. Every month that China buys gold is another nail in the dollar's coffin. And yesterday, the Fed just handed them the hammer. The banks are selling gold they don't have to geopolitical rivals who are taking delivery of every last ounce. And the rivals are smiling because they know what I'm about to show you next. The banks didn't just lose a battle yesterday, they walked straight into a doom loop that their own math says is impossible to escape. This is the part that breaks the entire system. And once you understand this loop, you will never see the financial system the same way again. The margin hike was supposed to scare leveraged traders into selling their gold. But the traders holding gold right now aren't leveraged speculators gambling on margin. They're central banks. They're industrial manufacturers. They're stackers who paid cash. You can't margin call someone who owns their metal free and clear. So the margin hike backfired. It only crushed the bank's own trading desks, who now need even more cash to maintain their massive short positions. That's why they sprinted to the Fed for $23.40 billion in emergency money. But here's the trap they just walked into. That $23.40 billion is fresh money, newly created, injected into the financial system. New money means more inflation. More inflation means the dollar loses value. A weaker dollar means gold priced in dollars goes higher. Higher gold means the bank's shorts get worse. Worse shorts mean they need an even bigger bailout. A bigger bailout means even more money printing. They raised margins to kill gold. The margin hike required a Fed bailout. The bailout printed money. The printed money makes gold stronger. Stronger gold demands a bigger bailout. A bigger bailout prints more money. More money makes gold stronger still. Round and round and round. This is the dollar death spiral. They are fighting fire with gasoline, and the fire is winning. No margin hike can fix this. No paper dump can fix this. No coordinated attack can fix this. Because the problem isn't the price of gold, the problem is the solvency of the institutions that are short gold. And you cannot fix insolvency by printing the very currency that is causing the insolvency. The snake is eating itself, and every bite makes your gold and silver worth more. So what do you do right now in the next 72 hours? Here is your battle plan. Objective 1. Do not panic sell into the smash. The paper price is a manipulation. The real price of gold and silver is what your local dealer charges. Check the premium over spot. That number is reality. Objective 2. Monday morning, watch the April COMEX delivery notices. If standing for delivery numbers break above 15,000 contracts, the physical squeeze is accelerating, not ending. I will cover this number live on this channel. Objective 3. Monitor the Fed's emergency cash facility every single day this week. If it stays above $20 billion, the banks are still hemorrhaging. The data is public and free. Link is pinned in the description right now. Objective 4. If you have dry powder, and I mean only capital you can afford to hold for 12 months or more, this smash is a gift they accidentally handed you. They just put gold and silver on a fire sale. While the fundamentals have never been this explosive, the sale will not last. Objective 5. Send this video to one person in your life who has called you crazy for stacking metal. Don't argue with them, just send the link. Let the timestamps, the $23.40 billion, the death spiral, speak for themselves. Every person who understands this is one more person who will not sell into their next attack. Your knowledge is their kryptonite. Numbers are armor. Let me leave you with this. In 1968, the London gold pool collapsed. Central banks burned through billions trying to hold gold at $35. They failed. Gold went to $850, a 2,300% rise. Today, the COMEX gold pool and the paper silver machine are collapsing in real time. They burned $1.70 trillion in firepower yesterday. Gold is still above $2,900. Silver is still above $30. The death spiral is still accelerating. Their weapons are failing. Their vaults are draining. Their own emergency data is screaming insolvency, and the serpent is still eating itself. You are not early anymore. You are not crazy anymore. You are exactly where history needs you to be. This is Financial Joe Alert, and the bloodbath they created yesterday just became their death certificate. Now, listen closely. The banks have a kill switch. It's called force majeure. It's a legal clause buried in the fine print of every futures contract that allows the exchange to refuse to deliver your gold and hand you a worthless paper check instead. They've used it before. They will try to use it again. In 48 hours, I am going to show you 3 specific COMEX delivery data points that reveal the exact date the system is mathematically projected to hit that kill switch. When that happens, the paper price of gold and physical price of gold will split permanently. And if you are not positioned before that video drops, you will be locked out. The door will close, and it will not reopen. Don't just subscribe. Join the community that refuses to be exit liquidity for the banks. Hit the bell icon right now, because that force majeure video drops in 48 hours, and it will change how you see this market forever. You have been warned. I'll see you on the other side of this collapse.